2024 has certainly been an exciting year in the market so far, and fixed income markets are no exception. Joining me today to delve into what the recent elections mean for local fixed income markets and looking ahead into 2025 is Assistant Fund Manager Ané Craig. So Ané, we've had two major elections taking place so far this year. Of course, the local elections as well as the US presidential elections. Now, after the formation of the GNU earlier this year, we've seen something of positivity coming through towards SA markets. But how has the recent US election outcome impacted on local fixed income markets?
So elections have immediate market implications in the short term. As you pointed out, after the formation of the Government of National Unity from the May elections in South Africa, our bonds performed really well. And then as we got to the US elections this year, our bonds sold off a little bit alongside US bonds, subsequently have done quite well. That's less interesting than the more medium-term and longer-term implications as a result of the elections. And that would be, what does President Trump and his government's policies impact, how it impacts the real economy, and then also things like financial sentiment. So on the real economy side, we expect his policies to be positive for nominal growth, and we expect them to be more inflationary rather than not. But there's quite a lot of unknowns, and the first reason for that is that politicians say one thing on the election trail, and then what they actually do once elected can be quite different. But also looking at some of his policies in isolation, one doesn't necessarily know what the long-term implications will be. Take tariffs, for example. So you've seen the dollar strengthen as a result of Trump's ability to enact higher tariffs on China and globally, and that should be strong for the dollar because the US is going to be importing less. But will it actually be positive for US growth and for global growth and trade volumes? We don't really know yet. There are other unknowns, like the US's relationship with the Middle East, with Ukraine and with Russia, with China, that could have obviously geopolitical implications, but could have, again, real economy implications, such as on trade volumes and oil prices, which have a direct implication on inflation. Outside of the US, there's also other unknowns, like Europe becoming increasingly protectionist. They are becoming very strict on their climate policies. This is negative for emerging markets. Generally, it just means that it's more difficult for money to flow from Europe to Africa because of these strict requirements that they have. You also have, this decoupling between China and the US, but then China itself is going through what we hope to be a cyclical low. When that China reflation trade actually takes hold and their construction cycle has bottomed, is still an unknown.
So, Ané, with so much uncertainty out there, how do you go about constructing portfolios to deliver on the ultimate objectives and help clients reach their goals?
Yeah. So we look at what we can put the highest probability on of occurring, and then we manage around the risks that we don't know, those known unknowns. So what we do have higher certainty of in this environment is that we're going to move into a space of higher inflation and higher than trend inflation and higher than trend global growth. So that's called an inflationary boom. Currently, we're in an environment that's known as Goldilocks, where you've got good growth and reasonably low and contained inflation. So we don't know when we move out of that, and we don't know for how long, but that is the most likely trajectory that we're going into. And that's an environment that's really good for commodities, for energy, for real estate assets. And it's not the best environment for bonds, but it could be a really good environment for bonds like South African bonds, where we need growth to get out of our own fiscal deficit and improve our debt metrics. So as long as you have growth that exceeds inflation, it's actually a positive environment for emerging market bonds as well. So that would be like a core thesis, and then you risk manage for all those many unknown risks that we mentioned previously around that.
So, Ané, given this environment, which assets would you be cautious on in a higher inflation environment?
So high inflation generally isn't great for bonds. As I explained, if growth still exceeds inflation, typically we see emerging market bonds perform well, but developed market bonds perform particularly poorly in high inflation environments. So we're cautious on US treasuries and other developed market bonds. So that's from a cyclical perspective. And the reason for that is that inflation eats into the bond yield that you get. So the yield above inflation, that real yield compresses. And then the other cyclical reason is that as equity returns improve, you find that there is a greater propensity to invest in equities, so that relative attractiveness of bonds diminishes. That's on the cyclical side. But then also structurally, we are looking at unprecedented levels of debt in the US. We have debt to GDP at 128%, and it's climbing. And you've got the annual interest bill of 1.4 trillion. So to give you context, that's double of what it was in 2020. And there's still a lot of demands on the fiscus, on Treasury in the US to spend. And we've got this new formation of the Department of Government Efficiency and sort of big headlines on 2 trillion of costs that'll be cut. That's actually really difficult to do. We've had President Trump say he's not going to touch Medicare, he's not going to touch defense. There's, of course, the massive annual interest bill. There's a lot of statutory requirements in terms of spending that he actually can't touch. There's not that much wiggle room. So we think you're going to have big, flashy headlines of costs that are going to be cut, but actually it's going to be quite difficult to reel in that budget deficit in the States. So if you have a higher deficit, that needs to be funded somehow, and that's funded through bond issuance and increasingly so. So from both a cyclical and a structural point of view, we'd be quite cautious on developed market bonds and US bonds in particular.
Now, Ané, thinking about government spending, the South African government has not been well regarded regarding their fiscal discipline over the last couple of years. So now, given this developing situation that we're seeing in the US, how do you weigh the relative attractiveness of SA government bonds?
Yes, and are we as worried about South African bonds as we are about US bonds? So as I explained, a bit of growth is always good for EM bonds, emerging market bonds like South African bonds. But as you pointed out, we've had a decade of over-promising on fiscal consolidation and under-delivering. So the market isn't quite believing that SA is becoming less risky. And for that, you're still seeing a 6% real yield, so that yield above inflation in our local bonds. For a government asset that is considered to be very low risk, somewhere closer to 2% real yield would be considered fair. So our bonds are still priced very, very attractively. And for the first time in a decade, we actually have the potential to increase output potential, so the ability for this country to grow and for GDP growth to meaningfully lift above 2%. That potential just structurally wasn't there in the last decade. And then also we have inflation that is very contained. So the SARB has done incredibly well to anchor inflation around 4.5%, and we know they have their sights set on an even lower target. So we do see the real returns in SA still look really attractive. That being said, when the US sneezes, the world catches a cold. So while we are very constructive on SA assets, as we started this conversation saying, there are so many risks on the global front that will have an impact on South Africa, even if it's just through sentiment. So it is a time where you want to put risk management front of mind. And we've done that through several actions in the portfolios, but particularly through building healthy cash buffers.
Ané, thank you so much for joining me today and sharing your insights on the way forward for fixed income markets into the new year.
Thanks, Audrey.